Good afternoon, everyone, and welcome to this webinar on tax planning and superannuation strategies. My name is Peter Lacandro, the Managing Partner of Chan & Naylor down here in Melbourne, at a very cold Melbourne at the moment. I hope that you're doing all safe and well, remaining positive, especially those Victorians, and getting through this COVID situation we find ourselves in. Especially, like I said, in Victoria and with a long weekend supposedly at home, I suppose. As a team, and obviously with the current situation we find ourselves in, and especially coming up to the 30th of June and tax planning season, we thought it'd be a great idea to provide this webinar around tax planning, superannuation strategies. We've basically met with many of you. We've all done many Zoom meetings and Teams meetings recently. We hope to meet some of you in the coming weeks before June 30, but we just thought it'd be a fantastic idea as a team to help you with some information to prepare for the end of the financial year. The team obviously in Melbourne are still working remotely. Yes, we had some very, very small relief yesterday. Offices are still restricted, and we'll see what happens in the coming week or so, getting the team back into the office. But we're certainly still here to assist in the best ways that we can. Obviously, technology, we're using that to the best of our ability, and you can certainly contact us via the normal realms of telephone, email, etc. And we'll certainly get back to you as best we can in that regard. Before we get stuck into this presentation, I need to go through the insurance side of things, and I do enforce that this is general advice only. It is not being designed for your specific situation or your particular circumstances. We're here to help further, but please get the appropriate advice from the experts in relation to your particular situation. What I will say, however, at the outset is there are many rules and strategies that many of our clients and businesses and individuals use each year to help them legally minimise their tax liability. In 60 minutes, which we have today, we can certainly cover some things, but we cannot cover everything. So please bear that in mind. Like I said, any tax planning strategy, any super strategy should always be considered and tied back to your particular goals and objectives. We're happy to talk, we can certainly do that, but just wanted to raise that at the outset. Okay, let's get stuck into it. So it's fantastic to have over 600 clients and prospects register for this webinar and listen in. Hopefully I'll go a long way towards answering many of the questions or doubts that you have in your mind. Some of the items that we will be discussing today, why is tax planning so important? What type of tax planning options are important and are available to us all? A big part of tax planning is how can we legally maximise our tax deductions. So we'll give you a few strategies in that regard. Superannuation strategies are very important, especially as we get older. So we'll look at some of those, whether to consider them and adopt them. We'll look at the banks because they're running hot at the moment and what you should be doing during these times. Also, the importance of financial planning and insurances. We'll look at that, and I'll finish with what to do next. If anyone has any questions, please feel free to use the comments tab with this presentation, and providing I have time at the end, I'll do my best to answer them. No need to take notes or anything like that, because a recording of this webinar along with the PDF slides will be popped onto our website, and I'll show you how to access that later on within about 24 to 48 hours after this presentation. So like I said, I'll show you how to access that later on. Okay, firstly, Why is tax planning so important? Well, the main objective of tax planning is to reduce the amount of tax you personally or your businesses pays. It leaves more for you to invest in your future personally or through your business. And most importantly, by knowing upfront or understanding your tax liabilities, you can then reinvest those monies or those savings that you may possibly make into your future wealth creation strategies. So whenever you are tax planning, there's a few important questions to ponder. Business owners out there, who of you truly know and understand your business numbers? Because how can you work, and when I say your business numbers, how's your margins looking, especially during the last 12 months during this COVID situation? What improvement strategies? Because anything that you can slightly improve, even if it's 2% improvement per month, can make a massive difference to the bottom line. Individuals out there, who truly knows their mortgage or how their superannuation is performing? Again, how much do you need to repay each month on your mortgage to perhaps get rid of your loan in 7 years rather than the standard 25 years? How is your super performing? When was the last time that you checked that? What will your balance be when perhaps you get to 60 or that magical 65 when you're planning on retiring? How long will your money last or your balance last in retirement? Will it be enough to meet your desired lifestyle? Or can you do something different to stimulate the balance in retirement? We work with many of our clients daily, weekly, monthly to help them ensure that these questions, along with many more, are at the forefront of their mind. And that's what tax planning will help achieve, along with superannuation strategies. Why else is tax planning so important? It's basically a process of analysing and evaluating either a business or an individual's financial profile. The aim of this activity, like we've alluded to, is to minimise the amount of taxes you can legally pay with either your business or on your personal income. In short, tax planning is employing ways that the government has provided to us to legally minimise taxes. And it's a perfect method and legal method to cut down or defer your tax liability until a future year. So if it's not important enough for you to keep the money in your pocket rather than give it to the ATO or perhaps another government organisation, then you should be standing up and paying further attention. How can we minimise tax planning options? And what are they that are available? So when we're looking at tax planning, and as a team of professionals, we always look at two things. Firstly, how can we legally minimise income? So how can we legally reduce it through tax planning techniques? And the second is, how do we legally bring forward, where possible, expenses? Or how can we take advantage of different rebates and offsets out there for tax purposes? When we're talking about tax planning, there are a number of tools out there that both individuals and businesses use. The first one that we use, and it commonly gets the media attention as well, is how can we accelerate tax deductions? What types of things can we do? And I'll go through a few of these as well in a moment. Utilising government offsets and rebates. So both the state and federal government, and especially at a federal government, because they're responsible with the tax legislation, over the last 15 or so months during COVID, have come out with some great incentives for businesses and for those of us individually, whether they be called offsets or rebates, that many of our clients are now utilising and will continue to utilise. Another tool of tax planning is controlling when income is recognised. And many people use those different savings from different sources as a reinvestment source back into the business to help fund further profits. So there's some of the common tools that many of our clients, and I'm sure many of you out there, are utilising each day to basically minimise taxes and as part of tax planning strategies. Again, before we get stuck into some of the strategies, please be careful. The ATO and the government have spent a lot of money over the last 12 to 18 months. They will and they are now starting to investigate and prosecute. We've seen those numbers rise. Not just with those that possibly claimed JobKeeper when they shouldn't have, but with tax return lodgements and businesses as well. The ATO and their investigators are now asking questions around different things. Just like the ATO is trained to do their jobs, just like we are. So they're using technology in areas with data matching programs, averaging programs to look at areas and taxpayers to audit. So like anything, please be careful. They are watching, and I don't see this changing anytime soon. If you need assistance or you're not sure, again, please ask. Okay, let's get stuck into some of the strategies for both tax planning and superannuation. And we'll look at the income side of things first, and then we'll have a look at some of the strategies we can use around expenses and also around some of the superannuation strategies to be used as well. So like I said, let's talk about the income side of things. So our objective, like we alluded to earlier, is to legally minimise our income. And I've underlined the word legally. What do people or businesses utilise? Especially individuals in this case. Salary sacrificing strategies is a common strategy used by many. Mortgage offset accounts are commonly used. And like I said, delay of income, legally of course, is another strategy used. So let's have a look at those each in a little bit more detail, and I've got some examples for you as well. Salary sacrificing. I'm sure many of you heard it, and I'm sure many of you utilise it. So salary sacrificing is basically a way to minimise your tax bill or legally reduce it. It involves your pre-tax salary to buy goods or services that you'd normally buy with your after-tax pay. In the eyes of the tax department, that means you're earning less when you're salary sacrificing. And if you're earning less, obviously the tax that you pay is less. Employers out there, when you have an employee coming to you to salary sacrifice or asking questions about can they do it, basically be very careful of FBT implications that may arise, because that'll rest with you as the employer. That's another topic for another day, but I just wanted to mention that quickly. Okay, let's have a look at a working example of how salary sacrificing works. So we have John Howard. John Howard earns a salary of $120,000 per annum. His salary sacrifices $13,000 to his super fund. So like any other employee, his employer would pay approximately 9.5% in SGC. He decides to send another $13,000 to super. And let's just assume that there's no other major issues or problems in this case. How will salary sacrificing benefit him? So currently, John Howard has a taxable income of $120,000. Tax, including Medicare levy, based upon that salary, would come in at about $34,297. Obviously, apart from his SGC amount, he's sending no further income to superannuation. So that's basically how it stands today with John Howard's situation. However, like I said, he'd like to salary sacrifice an extra $13,000 to superannuation. So instead of his taxable income being 120, it will drop down to 107, $13,000 less. His tax, because of that, along with Medicare levy, will also drop. And you can see the significant drop in taxes that he'll be liable for when he prepares and lodges his tax return. However, any money sent to superannuation from an employment or a concessional source do get taxed at 15%. In this case, $13,000 at 15% represents $1,950 worth of tax inside of the super. But as you can see, we have a saving here of almost or just on $5,000. Even though his super fund will pay some tax at 15% on that extra 13 grand, that represents an overall saving to John Howard of $3,120 in tax savings. Yes, some of that is tied up in his super now instead of in his own bank account personally. However, this is a simple example which can show and confirms the power of salary sacrificing. An extra benefit for John in this case as well is that after taxes, he has approximately $11,000 in his superannuation fund, which will get invested and will be there for his later on in life for his retirement. So that will continue to earn revenue, be taxed at concessional rates, and he's put it away for a rainy day. So like I said, that is a very simple exercise, but a salary sacrificing strategy, depending upon your circumstances, can work quite effectively. The next one that I wanted to chat about around income and helping us reduce income is around mortgage offset accounts. What is a mortgage offset account? It's a transaction account that's linked to your home loan. Again, we have many clients out there utilising this. And I know we have Lucy, our internal mortgage broker at Chan and Naylor in Melbourne, helping out many of our clients with this particular transaction or setup. A mortgage offset account, like I said, it's linked to your home loan. And the account's balance here is offset daily against your home loan balance. So they work as an offset. And I've got an example in a moment. So as a result of that, the benefit is that you're only charged interest on the difference between your total loan balance and the amount of cash in the offset facility. Let's have a good look at an example to explain further. So in this case, we'll just call it Jack, has a home loan belonging to his PPR or his principal residence that he lives in of $1 million. And let's just assume that he's paying 4% interest on that home loan. He also has a cash account in his own name. And basically that has $700,000 sitting in it. And let's say he's earning, or the bank pays him, or maybe another financial institution of 2%. And again, there's no major issues or other issues at this point. Let's have a look how the savings and how this can benefit him all up. So like I said, he has his home loan, $1 million at 4%. Obviously, there's a $40,000 interest expense which is non-deductible to him because it's on his private dwelling each year. Yes, if he reduces his balance, then he'll pay less interest. He has a cash account that has $700,000 in it currently, earning 2% per annum. Yes, the banks at the moment are not charging or paying investors that amount, but it will go back up one day. So he earns $14,000 worth of income. That income must be included in his personal tax return as assessable income and would be taxed at his marginal tax rate. So basically, not only is he paying private interest, he also needs to include this small income that he's earning in a tax return. And if he's on the highest marginal rate, will almost lose 50 cents in the dollar in tax. So that's currently what's happening. However, let's say Jack goes and talks to Lucy to set up a mortgage offset facility with a bank. What would happen in this case is the $700,000 and the $1 million would offset each other. So all that would be remaining is a home loan with $300,000, which will get charged interest at 4%, which comes to $12,000. So that would represent a saving there, 40 compared to 12, of $28,000 alone just in interest. Plus, this $14,000 would not need to be included in his tax return, so there would be further tax savings, possibly another $7,000 if he was on the highest marginal rate. Now imagine if this happens each and every year. It will grow, and each and every year, your savings as well. So basically having an offset facility, the other added benefit is that you're also able to withdraw money if needed. For example, if another investment opportunity may pop up or arise, it gives you flexibility of how and where you invest your money. So this is a fantastic tool to reduce income as well that's shown on your tax return. The final one, so actually before we get stuck into that, mortgage offset, how do you set this up? Well, I'll show you I'm going to give you some tips later on of what you can do next to get this stuff, and we can assist most certainly. The final one that I want to look at is delaying income. It must be done legally. Be very, very careful. So part of that strategy is deferring invoice. So if your cash flow can stand it, think about deferring some invoicing till after the 30th of June. A 1 month delay in billing, though, will mean that you pay tax on it a year later in your tax return. Be very careful, though. Your customers or your clients might want you to pre-bill in June so that they can claim a tax deduction. A few days later in billing will also possibly mean that you get paid a month later. So be very careful with this strategy, but it's something that some businesses do utilize. But you need to get the right advice and make sure you're ticking the right boxes with this side of things as well. Okay, so we've looked at some of the tools or some of the techniques and strategies to reduce income. Let's now have a look at the expenses side of things. So we've basically got a few different tools of tax planning here. Obviously, the most common one that many use is accelerating tax deductions. We have government and utilising government offsets and rebates, and I'll show you a couple of those in a moment. We already quickly spoke about controlling when income is recognised, and we've also spoken a little bit about reinvesting back into the business, and I'll show you an example of those in a moment. Many of these fall under the same umbrella, and many of our clients do utilise some of these techniques to legally minimise or certainly defer their tax liability until future financial years. All right, let's have a look at some of the most common. So some of the most common out there, we'll talk about bringing forward expenses, possibly a few months. We'll also have a quick look at prepayment of expenses up to a 12-month rule. I do want to cover a government offset at the moment available to businesses, and it's basically full expensing of eligible assets out there. And then we'll get stuck into some superannuation strategies, and we'll look at contribution caps and bring forward rules to take advantage of some super stuff as well. What's the first one all about? Bring forward expenses a few months. This is a common technique used by many of our business clients out there. Even individuals can utilise this one to an extent as well. If you're going to spend money in perhaps July or August, maybe even September, why not bring it forward into June instead? What would some examples be here? Possibly placing that printing and stationery order. Maybe you need some new computer supplies in the office or at the factory. How about some office equipment that you need, like that printer that needs updating, or some IT like laptops, etc. Is there any repairs to your office or your work premises that you should be doing, or you're going to have to do in July or August? Why not bring them forward a month? Perhaps there's some telephone and electricity bills that you will receive in July. Why not bring them forward and pay them in June instead? July's rent. Ask your landlord if you can have the bill and pay it in June. Superannuation or SGC contributions that are required to be paid for your staff or your team members. Don't wait till July or perhaps August or September to pay them. Bring them forward into June and get them paid. And the list can go on and on. But certainly bringing forward expenses a few months is something that can basically minimise your tax this year and go a long way. And this becomes even more important if you're perhaps got a bit of a profit problem this year and you're not expecting to have such a great year next year. Well, why not bring forward some of the expenses into this year? The second part of that is what we call prepayment of expenses, and up to 12 months in some certain circumstances. So prepaid expenses are common in many, many businesses. And basically the 12-month rule allows for a deduction of prepaid expense in the current year if the right or the benefit paid does not extend greater than 12 months or the end of the following taxable year. So in this case, 2022 financial year. Some prepaid expenses that you could possibly take advantage of. The most common one is your lease or advanced rent. Perhaps give your landlord a call and say to him, listen, I've had a good year, I'd like to prepay the rent for up to 12 months. Providing the landlord is happy to accept that money because it will represent income on his tax return, or him or her, I should say, then you can prepay rent for up to 12 months. How about insurance policies? Contact your insurance companies. Perhaps there's some business advertising or marketing that you know you can prepay. Sometimes many businesses have a monthly obligation where they pay marketers to do certain things. Maybe bring forward the next 12 months, prepay it. And like we spoke about, upcoming subscriptions that you have. Perhaps there's the ability to pay up front with many of those. You must be a small business, though, to take advantage of many of these. What is a small business? It's basically where you are, if you're an individual or a partnership, company and trust, you're carrying on a business and you have an aggregated turnover of less than $10 million. But certainly there is the ability to prepay expenses up to 12 months. It's a way of deferring your taxes until a future financial year. Another big one that I wanted to mention, and it's certainly gained a lot of media attention, both last year's budget that the federal government held in October, and it was further extended just last month in the May budget from the Morrison government. So basically from the 6th of October last year, and now extended out to June 30, 2023, if you spend $150,000 on plant and equipment, on tools and equipment, or what's referred to as eligible depreciable assets, you are able to fully expense them in that tax year. So the government is encouraging businesses here to spend money on equipment and reinvest or build for the future growth. It's a way of driving spending through the economy when obviously at the moment there's been a lot of other things going on. Small to medium businesses can take advantage of this, and any business with an aggregated turnover of less than $5 billion can utilise this. This would include maybe a bakery buying some new equipment, perhaps your medical equipment that a doctor's or dentist's surgery would need, or perhaps the local carpenter or tradie spending some money at Bunnings on major equipment or a brand new trailer to carry all their tools in. So this is something that basically many of our clients are utilising. The good news with this one is don't panic that if you don't take advantage of it by June 30 this year, it's going to be around for a couple more years as well. So something that government introduced to encourage businesses to spend money. Small business write-off pools. So again, basically, many small businesses out there have been depreciating assets anyway. And as a result of that, they've basically been claiming tax deductions on depreciation on a year-by-year basis. In certain circumstances for small businesses, we have the ability to write off those small depreciation or business depreciation pools, as we call them. For those of you that are clients, we will look at this when we do your financial statements. And certainly if we have the ability to do this, we will do it and talk to you about it and communicate that with you. For those of you that are clients out there, you should be double checking this with your accountants to see if you're eligible to fast track depreciation and bring it forward into this financial year. Be very careful though with depreciation and acceleration of it. So it's fantastic. We get a depreciation claim right now or in this financial year. That equals less taxable income, which obviously equals less taxes today. Be very careful though, because in the future, for example, that plant and equipment or maybe that motor vehicle that you've bought for business purposes, remember the value of it in the books is now zero. So if you go to trade that in and possibly sell it for value, then you could have some future taxable income. And also, depending upon your business registration status, there might be some GST that arises. So certainly speak to your accountants or communicate with us to see if this strategy is good for you. It puts money in your pockets today. That's the key. And that's what tax planning is all about. So there's some of the tools that many of our clients, both businesses and individuals, use for tax planning purposes. Let's have a look. So the next bit is I want to touch on is superannuation. And this becomes very, very important because obviously getting yourself sorted for your financial well-being later on in life should not be taken for granted. It shouldn't be assumed. You don't want to live off Centrelink because certainly I believe you deserve more of a lifestyle than a pension payment each week. So let's have a look at some of the strategies that you should be utilising around superannuation. The one thing that I will stress though, superannuation is very complex. Everyone's situation is different. We have Daz in the office who's a full-time financial planner and sits down with many of our clients around many of these strategies. It is specialised advice. So please reach out and ensure that you've got the right person and the right network to help guide you around superannuation. Some of the strategies that we'll look at and that I'll touch on is let's have a look at the $25,000 contributions cap or concessional cap as it's referred to. We'll have a look at the deductibility of personal contributions that we can all make. We'll also talk about non-deductible contributions that we can make and the benefits there. And then we have D&E, where we have the ability to split contributions, even balances between spouses, or consolidating balances between spouses. Sections D and E, they are very technical, very complex areas, and something that should be investigated on a case-by-case analysis or basis. I'm telling you this because many of our clients do utilise these two strategies, and it certainly goes a long way towards possibly helping with Centrelink benefits that you might be entitled to and wealth creation strategies. However, proper financial planning should be done with these two, especially to ensure that you're doing the right and ticking the right boxes. Let's have a look at the first one. SGC or super guarantee charge, contributions, and the $25,000 cap. So basically speaking, for the financial year that we find ourselves currently in, 2021, we're all going to have to do tax returns very shortly. The general concession cap is $25,000 for all individuals, regardless of your age. There is a slight increase that will be happening from July 1 this year, up to $27,500. So it just gives us the ability to tip a little bit more in. What is a concessional contribution? Let's have a look at that a little bit further. It includes contributions or employer contributions made on our behalf. And this would also include any arrangements under salary sacrificing, like that example that I gave earlier with John Howard. It would also include any personal contributions that are claimed as a tax deduction. And we'll go through that in a moment as well. Be very careful if you have more than one fund. All concessional contributions made to all of your funds are added together and accounted towards your concessional contributions cap. So you can't double dip or triple dip if you have 3 funds, for example. It's not 25,000 per fund. It's an all one encompassing. Be very, very careful because super does get taxed at 15%. Okay, and possibly outside of super, it can get taxed a lot more. So that's why people basically do it. Let's have a look at the personal side. So personal tax deductible contributions are contributions that you personally make to your super fund. Actually, I just forgot one thing. Sorry, I'm going to go back one slide. So why should you, many of you are working, and that's where we use the salary sacrificing strategy before. So inside of super, all contributions get taxed at 15%. So should you be salary sacrificing or tipping more in, because possibly you're already on a tax bracket of 30 or 35 or even 45% outside of super, including Medicare levy. So that's where people take advantage of the full cap rather than just the SGC amount. So I just wanted to touch on that quickly to make it clear. Again, a couple of years ago, the government brought another rule in, and this was never around if you already had an employer contributing on your behalf. But now we have the ability that we can make personal contributions into our super fund and get a tax deduction for it on our individual tax return. We need to meet certain criteria or eligibility criteria though. Let's have a look at an example. So in this case, we have Fred. He is self-employed and earns $50,000 a year. Fred contributes $5,000 to his super fund. Doesn't matter whether he does it on June 30 or whether he does it on a weekly basis. However, let's just say it's $5,000 for the year. He lodges his a notice of intent to deduct to his super fund, and they acknowledge that they've received it. Therefore, he claims $5,000 as a personal tax deduction on his return. His taxable income, assuming no other circumstances or deductions, is now $45,000, not $50,000. Obviously, that means Fred will pay tax on $45,000 and not the $50,000 that he normally would. So that's why someone would do it, and the benefit of getting a personal tax deduction. This can be made as well, or as a personal, there is also a non-concessional or non-deductible contribution. So this generally is money after tax that you'll send to your super fund, and your super fund will not pay tax on this contribution. Okay, from the 1st of July 17 to June 2021, the non-concessional cap is $100,000. From July this year, it's going to increase to $110,000 per annum. There is also a carry forward rule available where you can carry forward 3 years in total. So that would mean a contribution of $300,000, or in the future, it's going to be $330,000. Be very aware though, that if you contribute more than the various caps, whether it's this one or the other SGC cap that I discussed with you, you will be subject to extra taxes, and the tax office will marry that up. Why would someone tip in after tax dollars into their super fund? Especially as we get older and the added benefit of doing that. Well, it's basically getting money into a less taxed or a tax-free environment if you're in pension mode. So many of our clients utilize this strategy to get money into their super fund and paying less taxes on it in the future and saving for their retirement. So basically, that's why many of it do it. There is a carry forward arrangements, and this was again a rule introduced by the government a couple of years ago, to basically mean that people, if they didn't utilise their caps previously, could possibly do it now. So it applies from the 2020 financial year. And like I said, it allows extra contributions or concessional contributions to be made above the caps. Conditions: Member balances must be less than $500,000 to take advantage of this. Availability, you can access it for up to 5 years, and I'm going to show you a working example in a moment. And remember, or reminder, that the cap this year is $25,000. So let's have a look at an example. Well, this is in simple terms how it works. So let's say in the 19 financial year, the concessional caps or the contribution that you made into super was 20,000. The cap was obviously 25. So there was an unused cap balance of $5,000, which could get carried forward to next year. The following year, we made a concessional contribution of 15. Again, the cap was 25. There was a spare $10,000 there. Added to the 5,000 last year, we now have a carry forward cap available of an extra 15,000. Perhaps in 2021, there was nothing made. Maybe you had 12 months off work. Obviously, the cap was still 25,000. So you've got that cap available to you in the future, which we now have a $40,000 amount. And I think you get the gist there over a 5-year period. And you can see how quickly that can add up. This is an example of how Sam, in this case, can utilise this strategy and take advantage of this carried forward concessional rule. So like I said, in the 19 year, Sam had contributions of $5,000 made from his employer. His end of year balance at the previous year was $480,000. So he was under that 500,000 rule. So basically, he can carry forward or has an unused concessional cap of $20,000. Sam couldn't contribute any more during that year as he had no money. The following year, his employer made $3,000 contribution. His superannuation balance from the previous year was $490,000 and growing. So adding these two together, so the 22,000 short this year, plus the 20 from last year, he now has a cap carried forward of 42,000. The following year, like we said, there was no employment and no SGC paid on his behalf, but his balance actually went above $505,000. So therefore, even if he wanted to, he cannot use this 67,000 as an unused cap rule because his balance went over 500. However, the following year, he's back in employment. He had the normal 10,000 from his SGC, 20,000 salary sacrifice as well, and he decided to tip in another 15,000 personally, being a total of 45,000. His fund experienced, though, some negative earnings because perhaps the share market or his property dropped. Therefore, this cap of 94,500, he can now, because his balance is less than $500,000, he can use this cap and contribute up to 94,500. So in this case, he's going to take advantage of 45. So as you can see, this carry forward rule is a great tool and many use it to contribute today and certainly in the future if your circumstances change. So don't forget that as a technique as well. What are the caps, just to confirm? Or actually one other thing that I did want to mention for employers out there and those of you that have staff and team members, doesn't matter whether you employ one team member or 100. Basically from the 1st of July, so in a few weeks, the SGC rate will be increasing from 9.5% to 10%. So on wages or ordinary times earnings of $1 million, 95, that will grow to 100,000. And you can see it's also programmed here in the future financial years to increase as well. So I just wanted to let you know, hopefully your accountant has told you this, but it's certainly going to cost you more in terms of hiring your team members in the future. Be careful as well. This will have ramifications with your possible work cover premiums, along with those of you that are part of payroll tax purposes. And the contribution caps for SGC purposes, like I said, is also planned to increase slightly. So that's more of an information session for you rather than a strategy as such. So I'm wary of time, so I'm going to keep powering through just to get through the slideshow, and then I can see we've got some questions, so I'll do my best to answer those for you. Keeping the banks honest. So like I said, let's have a chat about mortgage offsets and how we can keep the banks honest. At the moment, banks are hungry for new clients. Many of our clients are refinancing and have refinanced as we speak. There are cheaper rates out there, and people are getting and putting in place, and businesses for that fact, cash buffers. For those of you with investment loans, if your interest rate does not start with a 2, you're probably paying too much. And for those of you with your private mortgages or that house that you live in, it should be starting with a 1. If they're not the case, you're paying too much. Talk to Lucy in our office, who's a full-time loan broker. There's her email and contact phone number, and she can go shopping on your behalf and give you an idea if she can help or not. But it's a free service to you. The banks are hungry for money. You can also discuss with Lucy about how you go about possibly setting up offset facilities, if that was your case in that regard. Financial planning and the importance of it. I think I've covered a lot of that, especially when it comes to superannuation and setting yourself up for retirement and taking advantage of some possible Centrelink benefits. Again, we have Daz in our office. His contact details are listed here. That can help you. Financial planning is all about helping you today, but more importantly, tomorrow, and giving that lifestyle and that protection that you deserve. It's about getting yourself financially sorted. So many of our clients are doing that as well. Like I quickly explained to you, via our website, you'll be able to watch a copy of this webinar and download the slides, etc. And basically, this is where you can access it, okay? And it'll be up about 24 to 48 hours after the conclusion of this webinar. I also just want to bring to your attention that we already have a few webinars up on there that if you want to follow up on, or maybe you missed previously. They were last year's things like budgets and JobKeeper updates. We also did have some webinars on property around tax deductions available, structuring and asset protection. So more than happy for you to jump on, and there's the link on our website to watch those. Also on our website, and coming up to the financial year, there's plenty of free resources available for you, from brochures, newsletters, news articles. We also, coming into tax time, have over 30 occupation guides that will help you legally minimise the taxes that you may possibly pay, depending upon your occupation. So if you're a nurse, if you're a carpenter, if you work for the police force, and the bus drivers, the list goes on and on. Pick the occupation guide that's most relevant to you and download it and have a read of it, of what you can claim. We also have our PDF and tax checklists, and for the current year, they will be up shortly. And many of our clients are utilising our client portal area through our website, where you can upload, download and store documents, copies of things for your benefit. So that's important on the website. Go on there, have a look. It's there for you to utilise. Also, just in relation to today's webinar, there's some tax planning guides that you can download. So they're basically located on our home page. And if you go about halfway down, you can see that there's one for individuals and there's one for businesses. So they are in more detail notes of some of what we've covered today, along with many more strategies that you can utilise as well. So feel free to help yourself in that regard. Before we get stuck into what's next, I'm just going to try and check some of these questions, so bear with me to see if we can answer them, because we've got about 3 or 4 minutes before we finish up. So the first question, anonymous, I would want to know, if I put money in trust for my children, how can I minimise tax payable by them? That's a very complicated question, because it depends how much money you're talking about. If it's only a little bit, you know, around a small bank account or something like that, they probably won't have too many tax implications. So probably that would be a question. Contact Daz in our office as a financial planner, and he would certainly go a long way towards helping you in that regard. I want to give children to my money, put them in trust for their protection from their partners. How do I minimise tax? One child would have a trust. I think what you're trying to say there, and again, this is from an anonymous person, yes, we can put money and gift money to our children. In terms of protecting it from partners and things like that, there are structures that we utilise as accountants, but I would be seeking legal advice in that regard, because if anything was to happen, that would be a legal opinion that you require. We certainly can have a chat, though, around structures that we utilise in that regard. We have Selman, who's asking a question regarding SMSFs. There are two parties at arm's length and wanting to buy a property and add value by reno or construction. The bank does not give SMSF loan for construction. Can parties use their own funds for transferring into a super, using it for the reno or construction? Perhaps a trust structure could be utilised. Okay, so again, there's a little bit in this question. Yes, superannuation legislation is very tricky. The one thing that we need to do is to make sure that we are not contravening any laws. The biggest problem I can see here is once you tip money into a super fund, unless the right boxes are ticked, it is very difficult to get that money out of super. So I'd suggest with this case, I'd need to understand a lot more, probably to have a consultation to see if we can help you. We have Chris. If I make weekly sacrifices into super, do I have to give the super fund a notice of intent? If it's a salary sacrifice form, Chris, no, you do not, because it's coming from pre-tax dollars. If it's coming from after-tax dollars and you wish to claim a tax deduction for it, then yes, you must complete a notice of intent. So hopefully that answers your question. How do I, again, another question, how do I know if mine is a pension fund? I presume you're referring there to your superannuation fund. Hopefully you get a statement if it's a retail or industry fund. You will need to contact, or it hopefully will be listed there if it's a pension fund, or contact your super fund for further clarification. If it's a self-managed super fund, which we have many of our clients that we assist with, then you need to contact your accountant to double check that. The example shows events over 4 years. Are we able to only use the carry forward rule for 3, or is it 3 years aside from the current year? Basically, if you're talking about the superannuation carry forward year, Generally, it is applicable for up to 5 years. I've just used 4 years as an example, obviously because I'm limited by time. Can I claim a tax deduction on carry forward concessional rule in the present year? Generally speaking, yes, providing you've ticked the eligible criteria and making sure that you haven't contravened anything else. Josie, if my partner has made a 3K spouse contribution to me as I earn under 37, does that count towards my cap? No, that is a separate rule. And that's your partner making it on your behalf, and he could then claim that rebate on his personal tax return. If I have a single SMSF with my wife and the member balance maximum 500 per person or total, I'm sorry, I'm not sure what that question means, so yeah, I won't try and answer that one. We've got a couple of questions. We've got a couple of thank yous for doing tax returns for Sandro and Janine, so thank you for that. If buying an investment property, 20% from my home mortgage offset account, 80% from a new mortgage backed by the investment. In the future, this investment is sold. The cost will be 20% plus 80%, regardless of where the money is paid from. I think what you're asking there, well, generally speaking, if you're talking about capital gains, whatever you bought the property for, no matter where the funds come from, versus what you sell the property for, obviously adjusted for different costs, etc. That's how we determine the capital gains. What is the impact of the super balance being greater than $1.6 million? I haven't got time to get into that question because that's probably another massive topic for another day. More than happy for you to give us a call and happy to have a chat with you offline. Thanks for your help. So I've just got a couple more questions before we wrap up. We'll see if we can do a couple of them very quickly. I'm a sole trader. Want to use salary sacrificing to pay myself some super. Is this different for me versus my employer? Anything that I'm watching out for, I need to watch out for. Basically, if you're self-employed and you want to contribute to super, that's where you'll need to contribute to super, fill in the notice of intent claim, and basically that'll allow you to claim it as a tax deduction because you've got that notice of assessed claim. How much do financial planners charge? I'm interested in building wealth via a super fund. More than happy for you to give us a call in that regard. It varies dramatically, to be honest with you, Vanessa, but happy to answer where we can. Just seeing if there's any other quick questions because I'm wary of time. Do you know if additional personal super contributions affect income calculations for child support? The short answer to that is possibly yes. It depends what you mean by personal super contributions. Again, Centrelink have their own rules. We can certainly advise, but generally it's not a strategy that will help minimise any child support payments that you need to make. Is the instant asset write-off available for assets purchased for rental properties? I presume you mean the COVID 150 rule. The short answer is no, unless rental properties is your full-time business. It is only available to businesses in that case. Can I do asset write-off of a car purchased amount? Again, the short answer to that is if you have a small business, the car is in the business name and you tick the other criteria, then we've had many clients that have utilised that rule. So hopefully that goes a long way towards answering many of the questions. Feel free to reach out. What should we do next, or what should happen before June 30? So we'll wrap up, and thank you everyone for hanging around for an extra couple of minutes. What should I do leading into June 30? Basically, we went through many of the strategies. Do yourself a favour, come back, have a look at the PDFs just to refresh, download those brochures off the website, which will give you some more heads up around strategies and more details. Anything that you want to put in place, you should be doing well before June 30, because once it hits basically July 1, it's too late in many situations. What should happen on June 30? Well, as accountants, we'll probably have a drink and celebrate. But in your case, as long as you've done all the hard work before June 30, there's nothing else that you should really do on June 30. And what should happen from July 1 onwards? Again, for tax planning and super strategies, we're into a new financial year. So there's very little that we can do. What should happen though is I would be gathering for our clients especially, and for those of you that need assistance, get your numbers together, get your tax returns together, all the documents that we require. Let's get your taxes done as quickly as possible, because that then can lead to some strategies for next year. So I'd just like to take this opportunity to say, firstly, thank you for joining in today and sending me the questions and taking some time out to listen. In wrapping up, what are the next steps? Talk to us for assistance. We're here to help. That's the key here. Make sure that all your compliance is up to date with the ATO. They are getting heavy. They are starting to ask questions. So it's imperative that you do that, from your tax returns to BASs to super obligations. And it's time for you to get financially sorted. No one is going to knock on your door and force you to make decisions. But most importantly, it's up to you to take the action and to look after your finances and your wealth creation. So again, this is how we can be contacted. More than happy to assist. Thank you. And if there's anything else that basically you require, me and the team, we're all here to assist. So thank you very much. Stay safe. Enjoy the long weekend where we can, and in Melbourne, stay warm as well. Take care, and we'll speak to you all soon. Thank you. Bye-bye.